Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over the passive activity rules and loss limitations. And we're going to be doing it the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training, where we go over the key ingredients to passing the CPA exam. Again, it's 1 hour. It is free, and it will save you so much time struggling with your process. Make sure you go check it out. The link will be in the description. Also, in this video, we'll only be going over 5 questions, but Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. With that said, let's dive straight into the questions to learn this topic. Okay, here is question 1. John owns 2 residential rental properties. Property A generated rental income of $12,000 last year, while property B incurred a loss of $17,000. John also works as an engineer, and his modified adjusted gross income, or MAGI, for the year was $160,000. Considering the passive activity loss rules, how should John report the net losses from his rental activities? Okay, there's a whole bunch of different options here, but if we don't really know how the passive activity loss rules work in the first place, then this is going to be really difficult. So let's go ahead and dive straight into the answer to start learning how this works. Okay, it looks like the answer is that the net loss from property B of $17,000 and the net income from property A of $12,000 results in an overall net loss of $5,000. Okay, that makes sense, which should be carried forward to future years as it cannot be offset against other types of income. Okay, let's read the explanation here. So this says what we just read. This loss cannot be deducted against non-passive income such as wages and must be carried forward to future years to be offset against future passive income. All right, well, let's read a little bit more about this. A passive activity is defined as any business or trade in which a taxpayer does not materially participate on a regular, continuous, and substantial basis. The most common examples include rental properties and businesses where the taxpayer is an investor but does not have a significant role in the day-to-day management or operations. Passive income, therefore, includes earnings from these passive activities, such as rental income from real estate or earnings from a business in which the taxpayer does not actively participate. It's important to note that passive income does not include income such as wages, portfolio income like dividends, interest, and capital gains from stocks, or retirement income, all of which are considered non-passive. Losses from passive activities can only offset income from other passive activities unless specific exceptions allow them to be used to offset non-passive income. And we will learn about those exceptions in this video, but in general, the idea is that most income is not passive income. It's really only from rental income and potentially a pass-through entity that you don't really materially participate in. So things like dividends, interest, and even capital gains, which, by the way, at first, before I learned all this stuff, I would have thought that dividends and interest were passive income, but they are not. They are considered portfolio income, which is treated a little differently compared to rental income. So the general idea, though, is losses from passive activities can only be used to offset income from passive activities. And we'll learn about the exceptions to that later in this video, but that's the general idea right there. So let's go ahead and go to the next question to learn some more. Okay, here is question 2. Sarah is a licensed real estate agent who works full-time in the business of buying, selling, and managing real estate properties. Last year, she spent 1,100 hours working in her real estate business and 900 hours at another job. She owns 3 rental properties, each resulting in a financial outcome as follows. So property 1 had a net loss of $2,000, property 2 had a net loss of $5,000, and property 3 had a net income of $1,000. And her total income from her other job was $50,000. So how should she report her income and losses from her real estate activities? Okay, so we just learned that passive losses can only be used against passive income, but we were told that there were some exceptions to that. So who knows? Is this one of the exceptions? It does say she's a licensed real estate agent. So if you want, go ahead, pause the video, and see if you can figure it out or take a guess. But otherwise, let's go ahead and dive into the answer to learn if there's some kind of exception that we don't know about here. Okay, and the answer is that she reports a net loss from her rental activities, which she can use to offset her salary income, resulting in an adjusted gross income of $44,000. So this is in complete contrast to what we just learned in the first question, so this must be one of the exceptions that was mentioned. So let's go ahead and read about it. Sarah qualifies as a real estate professional because she spends more than 50% of her working hours, so that was 1,100 of the 2,000 total hours, in real estate businesses where she materially participates, and she also surpasses the 750-hour minimum requirement in these activities, meeting both requirements to be considered a real estate professional. So those are the two requirements. Both of those have to be met to be considered a real estate professional. As a real estate professional, the passive activity loss rules do not apply in the typical manner. Instead, her losses from rental activities, even if they are passive in nature for others, are fully active for her and can be used to offset her ordinary income from other sources. This allows her to use the $6,000 net loss from her properties to reduce her other taxable income, demonstrating the significant tax advantage of meeting the real estate professional criteria. Okay, so basically, if one of your main jobs and a lot of your time is spent actively managing real estate properties and you're materially participating, it's mostly your full-time job or around there, then you can be considered a real estate professional, and then these rules that we just learned and that we're going to learn through the rest of the video don't apply to you. So this is one of the exceptions. Let's go ahead and go to the next question to learn more about passive loss rules and limitations. Okay, here is question 3. Mark and Jenny, a married couple, actively participate in the management of their rental property, which they own together. This year, the property incurred a net loss of $30,000. In addition to the rental, they have a combined salary income of $90,000. Their modified adjusted gross income, or MAGI, is $95,000 for the year. Given their situation, how should they report the loss from their rental property on their tax return? So this looks similar to what we just saw in the first question. You might assume that $30,000 is going to be suspended and carried forward to the next year to be used against passive income. But as you'll find out in the answer to this, there is an exception. So which one of these is correct? Again, can she deduct the full amount? Probably not. We learned that in the first question. Can she deduct $25,000 of it? I don't know why she would be able to do that. Does she need to carry forward the amount? I mean, based on what we learned in the first question, yes. And then I don't know why it would be $10,000. So let's look at the answer to learn if there's another rule that we don't know about yet. Okay, and the answer is that they can deduct $25,000 of the loss against their salary income this year and carry forward the remaining $5,000 loss. Okay, why? Let's learn about it. There is a $25,000 special allowance rule that allows individuals who actively participate in a rental real estate activity to deduct up to $25,000 of loss against non-passive income, such as wages, if their MAGI is $100,000 or less, and that does start phasing out completely at $150,000. We'll learn about that in another question. So what does active participation mean? Active participation means having significant, although not necessarily substantial, management decisions such as approving new tenants, deciding rental terms, and approving expenditures. It doesn't require a specific amount of hours like that real estate professional did. However, they must own at least 10% of the property. So basically, if it's not your main business, like it's not your whole livelihood, but you do actively work on it and it is important, then that's pretty much considered that you're actively participating. Now, since Mark and Jenny meet those conditions, they can utilize the $25,000 deduction against their other income and will need to carry forward the remaining $5,000 loss to the next tax year. This is an important tax relief mechanism for real estate investors who are not professional but are still actively involved in their properties. Okay, so this is another rule that we didn't know about. So generally, passive losses can only be used against passive income. However, if you're actively involved in the rental activity, you can take up to $25,000 of that loss and you can put it against your other income, and then whatever amount is above that $25,000 is carried forward and suspended just like any other passive activity loss and used in future years. Now, it did mention that if you have MAGI above $100,000, it starts phasing out. So again, we'll learn about that in the next question. But this is an important rule when it comes to passive activity losses that you need to know. Let's go ahead and go to the next question. Okay, here is question 4. Laura and Alex, a married couple, actively participate in their rental property, which incurred a net loss of $25,000 this year. Their other sources of income include Laura's salary of $85,000 and Alex's consulting fees totaling $40,000. Their modified adjusted gross income for the year is $125,000. Given their income and the details of their rental loss, how much of the rental loss can they deduct against their other income this year? Okay, so we just learned about this. If you're actively participating, you can deduct up to $25,000 of it against your normal income. But again, we didn't really learn about that phase out where if you're over $100,000, it starts phasing out. So if you want, go ahead, pause the video and see if you can kind of think about it and guess at it. But if not, let's go ahead and click on the answer to learn how that phase out works. Okay, so the answer is actually only $12,500, so half. Let's look at that. Under the tax rules for rental real estate with active participation, there is a special $25,000 loss deduction allowance that begins to phase out for taxpayers with an MAGI over $100,000 at a rate of 50 cents for every dollar over $100,000. So that's a little bit confusing, but basically, for every dollar that is above $100,000, you take half of that, and that reduces the $25,000 deduction that's available. And so the phase out would therefore be 50% of the $25,000, which is $12,500. This means their allowable loss deduction is reduced by $12,500 from the maximum $25,000, allowing them to deduct $12,500 of their $25,000 loss against their other income this year. Now that's a little bit confusing because the net loss was $25,000 and then the allowable deduction is $25,000. Now, if they had had an MAGI below $100,000, then they would have been able to use that whole loss against their other income. But because their MAGI is over $100,000, that's where that phase out starts happening. So they're only able to take half of that $25,000 reduction. All right, let's go ahead and go to the next question. Okay, here is question 5. Thomas owns several income generating assets and activities. Last year, he received the following incomes. He had wages from his full-time job, net rental income, dividends, capital gains, income from a partnership where he doesn't actively participate. And so based on all that, what of that is considered passive income? Now this is recalling the first question where we kind of talked about what is considered passive income. So go ahead, pause the video, see if you can remember what we learned from that first question and do the calculation. And when you're ready, come back, we'll look at the answer together. All right, and the answer was $35,000. So let's look at this reminder. Passive income typically includes earnings from activities in which the individual does not materially participate. For Thomas, the $15,000 net rental income from a property he owns but does not manage, and the $20,000 income from a partnership where he does not materially participate count as passive income. This totals the $35,000. Dividends and capital gains are part of portfolio income and are not considered passive, they're considered non-passive. And so they're categorized differently for tax rules. So overall, $35,000 of passive income for him. This question was there to more remind you that, we've talked a lot about rental income because that's the main thing that we needed to focus on. But there is also income from pass-through entities where if you don't materially participate in that entity, that still can be considered passive income. And with that, we've gone through 5 questions. Before we go any further, let's go ahead and do one more part of the process called pillar topics. Now, the idea behind pillar topics is, as you're going through the questions to learn the material, you will notice things that keep popping up. You will notice the important concepts that are obviously trying to be taught by your review course because they've shown up in 3, 4, 5 questions or more. So okay, I obviously need to know this. And so you write down these pillar topics so that you know them for later and can remember them. So let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics. First off, passive income typically arises from endeavors in which there is no material participation by the individual or from rental activities, regardless of participation level. So for endeavors where you don't materially participate, and then when it comes to rental activities, it's always considered passive income, regardless of how much you participated. Passive losses can only offset passive income. If losses exceed income, they are carried forward to future years to offset passive income in those years. However, individuals are not bound by passive activity loss rules, what we just talked about, for their rental activities if they spend more than 50% of their personal service time in real property trades or businesses where they materially participate, and if they work more than 750 hours in these areas annually. It has to be both of those criteria. Meeting these criteria classifies them as real estate professionals, allowing them to use passive losses to offset ordinary income. So that is one of the exceptions to, passive losses only being able to be used against passive income. The other exception is this. Active participation implies significant involvement in management decisions without a daily presence or specific time commitment. It does require owning at least 10% of the property and applies only to individuals. Now that is an important point that we didn't really talk about because this is focused on individuals, but this rule does not apply to corporations. Active participants can deduct up to $25,000 of net passive losses annually, which phases out at a rate of 50 cents for every dollar of adjusted gross income above $100,000, ceasing past $150,000. Once you're above $150,000 of MAGI, then you don't get to take this awesome $25,000 deduction, and the net passive losses are not able to be deducted against ordinary income at all and have to be carried forward to future years. All right, with that, those are the pillar topics, and that's the end of the video. Make sure to go check out our free 1-hour webinar training on SuperfastCPA.com. Again, we teach the key ingredients to passing the CPA exam. It's something you don't want to miss. Also, if you liked this video, we only went through 5 questions, but Superfast CPA members will have access to the full 10-question video when we post it on the members forum. So again, if you liked this, you can get more of it and more practice by becoming a Superfast CPA member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.